Welcome to the Deep Dive. We're here to help you cut through the complexity and really get straight to the essential insights.
That's the plan.
Today, we are tackling a key document from the financial world, the Goldman Sachs 2024 Shareholder Letter.
That's right. And this isn't just some, dry report. It's the view straight from the top brass, the chairman and CEO, president and COO, and the CFO.
Right.
They're laying out performance from last year, looking back over 5 years, and giving us a peek at where they see things heading for the firm and, well, the broader economy, too.
So our mission here is to unpack this letter with you, pull out the most important facts, the key perspectives, and figure out what it all means.
Let's do it.
Let's jump in. First up, those headline numbers from 2024. How did the year look, just on paper?
On paper. Pretty strong, actually. They reported a 16% increase in net revenues compared to the year before.
Okay.
That hit $53.5 billion. And earnings per share saw a really significant jump,
How big?
up 77%. Came in at $40.54 per share.
Wow, 77% EPS growth.
Yeah.
That's definitely notable. How did that translate into, say, profitability and efficiency?
Yeah, good progress there, too. Their return on equity, ROE, which is, a key measure.
Right, how much profit they squeeze from shareholder money.
Exactly. That improved by over 500 basis points.
Okay, 500 basis points. Just quickly, for anyone less familiar, what is a basis point?
Good point. It's simple, really. 1/100th of a percentage point.
Right.
So 500 basis points means a 5 percentage point improvement.
Got it.
So their ROE landed at 12.7% for the year.
12.7% ROE. Okay. And efficiency. How are costs looking?
The efficiency ratio that tells you how much it costs them to make $1 of revenue, that improved quite a bit by 11.5 percentage points.
Okay.
Came in at 63.1%. And remember, a lower number is better there. Means they're getting leaner.
So better profits, better efficiency. How did the actual shareholders make out?
Well, the total shareholder return for 2024 was pretty robust, 52%.
Yeah, 52%. Wow. Okay. The letter includes a quote from leadership, something like, "The path hasn't been without challenges, but we're proud of the progress."
Yeah, I saw that. And they also look back, 5 years to their 2020 Investor Day.
Right.
And they mentioned meeting or even beating almost all the targets they set back then.
So that look back provides important context, doesn't it?
Absolutely. They feel like they have navigated a tricky period successfully. And now they're positioning themselves to deliver mid-teens returns through the cycle.
Through the cycle, meaning
Yeah.
averaging out over good times and bad.
Exactly. Not just one good year. And the focus now, they say, is really setting the firm up for the next 5 years.
Okay, that gives us the big picture. Performance,
Yeah.
the journey so far. Let's dig into how they're strengthening their core businesses. They call out two big ones: global banking and markets, GBM,
Mm-hmm.
and asset and wealth management, AWM.
Exactly. GBM is, their classic investment banking powerhouse.
Yeah.
M&A advice, helping companies raise capital, and their big trading arms in fixed income, currencies, and commodities. FICC, they call it, plus equities trading.
And they have a strong track record in GBM, some top rankings consistently.
Oh, yeah. They've been the #1 M&A advisor globally for 22 years straight.
22 years.
It's a pretty impressive run, yeah. They also talk about deepening relationships with key clients, gaining 350 basis points.
So another 3.5 percentage points.
Right. In wallet share since 2019 with their top 150 FICC and equities clients.
Wallet share. Sounds like just getting a bigger piece of the business from your most important clients.
That's basically it. And what's interesting about the revenue mix within GBM,
Tell me.
well, they've been deliberately growing what they call more durable revenues,
It's durable meaning.
meaning less dependent on, say, big market swings or unpredictable deal flow. Think FIC financing, equities financing, more steady business lines. And those grew at a 15% compound annual growth rate since 2019, hit a record $9.1 billion in 2024.
Okay, 15% CAGR. Just remind us what CAGR means.
Right, CAGR, compound annual growth rate. It's like the average yearly growth rate over that whole period, assuming profits get reinvested. So yeah, on average, these financing revenues grew 15% each year for 5 years. It shows a real trend, building a more stable base inside their markets division.
Building resilience makes sense. How's GBM performed overall, say, over those last 5 years?
Pretty consistently, actually. The letter points out that over the last 5 years, GBM averaged $33 billion in net revenues.
Okay.
And importantly, an average ROE of 16%.
16%? That's actually higher than the firm-wide average for 2024, isn't it?
It is, yeah. Highlights just how profitable GBM is for them.
Okay, let's switch gears to Asset and Wealth Management, AWM. What's the story there?
So AWM is all about managing money and giving financial advice for, a whole range of clients, big institutions, financial advisors, wealthy individuals.
And they hit a pretty big number in assets under supervision.
They did. A record $3.1 trillion in 2024.
3.1 trillion.
Yeah. And the key thing here, they say, is this marks their 28th consecutive quarter of long-term fee-based net inflows.
Okay, break that down. Fee-based inflows.
It means clients are consistently putting new money into strategies where Goldman earns ongoing management fees.
So not just market appreciation, but new money coming in.
Exactly, which is another type of that durable revenue we were talking about. And total client assets, just within the wealth management part specifically, that rose to about $1.6 trillion.
So steady growth, recurring fees. They mentioned durable revenues in AWM too, similar to GBM.
Absolutely. They actually surpassed their goal of hitting over $10 billion a year in management and other fees in 2024.
That was a target.
Yeah. And when you add that to their private banking and lending revenues, that whole chunk has grown at a 12% CAGR since 2019.
Another strong growth rate.
It is. And they expect that area to keep growing at a, call it, high single-digit rate in the coming year.
And the profitability of AWM, did that improve?
Significantly. They really boosted their pre-tax margin in 2024. Actually hit their medium-term target, which was the mid-20s range.
Okay.
And they're committed to pushing the whole AWM business towards mid-teens returns overall, similar to the firm-wide goal.
What about alternatives? Private equity, credit, infrastructure? That's a hot area.
Huge focus for them, huge area for investment and growth. They raised over $70 billion in alternatives just in 2024.
$7 billion.
Yeah. Scaling up their big flagship funds, getting deeper with institutional clients, and also tapping into their own wealth management clients for this. It's a key part of grabbing that growth in private markets.
Okay, speaking of private markets and credit,
Mm-hmm.
the letter calls this out as a major structural trend, right? And they've created something called the Capital Solutions Group to target it.
Yes, this is a really interesting strategic move. They see the massive boom in private credit and other private assets, basically financing happening outside public markets, as a major lasting shift.
Right.
And Goldman thinks they're uniquely placed to capitalize because they do advisory, they originate deals, and they invest capital across the board.
So connecting all pieces. And that led to forming this Capital Solutions Group starting in 2025.
Exactly. This new group is specifically designed to integrate all those different parts: financing, deal origination, structuring complex deals, managing the risk that comes with it.
And how does this fit into that one Goldman Sachs idea they often talk about?
Well, the way they explain it, it really leverages that mindset. This Capital Solutions Group kind of sits right at the intersection of their main businesses.
Okay.
It aims to serve banking clients who need private capital.
Right, the borrowers.
And also AWM clients who are looking for unique investment opportunities in those private markets.
Connecting the investors and the deals.
Precisely. Making it easier to match the capital sitting in AWM with the deal opportunities bubbling up in GBM and elsewhere. Sourcing deals across the whole firm, it's like a structural way to capture this huge private market trend.
That makes a lot of sense, connecting supply and demand internally. Okay, so beyond growth strategy, they're also focused on efficiency, running the firm better. What does that look like?
They've kicked off a 3-year program. 3 main parts to it.
Right.
1, optimizing their footprint, physical offices, organizational structure, basically how they're set up. 2, managing non-compensation expenses, better controlling costs other than salaries and bonuses. And 3, boosting automation and productivity, heavily leaning on technology.
And I bet artificial intelligence fits into that third piece.
Big time. Yeah, the letter specifically says many employees now have access to generative AI tools.
They give examples.
They do. Things like a developer co-pilot coding assistant, an internal natural language GS AI assistant, and other specific AI use cases already being rolled out across both GBM and AWM.
So it's not just talk, they're actually using AI tools now.
Seems so. They're implementing specific things. And the plan for 2025 is to keep integrating these tools more deeply into daily workflows.
And the goal is efficiency savings.
Yes, but not just cutting costs. The idea is the efficiencies gained from AI and automation free up resources, time, money, people that can be reinvested back into growth areas, and, importantly, improving the client experience.
Right. Of course, none of this happens without the right people and culture. The letter really emphasizes this point.
They state it pretty clearly. Their people are their most important asset, And they highlight their partnership culture as being really central to attracting and keeping top talent.
And that culture seems geared towards long careers, internal promotion.
It seems that way. They point out that lots of people spend their whole careers there. And get this, over 40% of their current partners actually started out as campus hires.
Wow, 40%? That suggests a strong pipeline.
Definitely indicates a strong internal development path.
They also seem to maintain strong ties with folks who leave.
Yeah, they mention this extensive alumni network. Over 275 alumni are apparently in C-suite roles at major companies.
Impressive network.
And they highlight something called boomerang hires, which I thought was interesting.
People coming back.
Exactly. About 380 alumni returned to the firm in 2024 alone, including around 25 former partners and managing directors. People choosing to come back. That says something positive about the culture and opportunities, right?
It certainly does. They also made some significant leadership changes recently, didn't they?
Yes, back in January 2025. Announced changes in key spots like GBM and client coverage, and added 18 new faces to the management committee, their top leadership group.
And what was the thinking behind those changes? What did they say?
They gave three main reasons. One, creating operating leverage for senior leaders, basically freeing them up to focus on strategy or cover more ground.
Well,
Two, providing growth opportunities for their own talented people. And three, just ensuring they have tested, experienced leaders in critical roles across the firm. They made sure to stress the experience these new leaders bring.
right, okay. Let's shift to looking ahead. The letter talks about a pretty dynamic, complex environment out there.
Yeah.
What are the key factors they're watching?
Well, they see real competitiveness and growth opportunities inside the U.S. economy. That's a positive. But
globally, they point to several things. Creating headwinds, creating uncertainty, persistent inflation is one.
still,
Yep. Potential for new tariffs, rising geopolitical tensions, ongoing conflicts, all creating drag.
and they contrast the U.S. with Europe specifically.
They do, noting that Europe's growth is still lagging the U.S., and they mention talking to European leaders, sensing some urgency about needing structural reforms, things like more flexible labor markets, less red tape.
Right, things to boost dynamism.
Exactly. But they also kind of question whether the public and political will is really there to push through those potentially tough changes.
Interesting observation. Now, this brings us to the impact of the U.S. election results, which they actually call out directly.
Yes, this part was particularly interesting reading their take on it. They noted a meaningful shift in CEO sentiment, especially in the U.S., right after the election results last year.
A shift in what way? More positive? It seems so. They suggest that based on the expectation of changes, particularly around the regulatory environment under a new administration, companies suddenly had more appetite for doing deals.
Ah, so M&A, capital raising.
Exactly. They think this anticipated regulatory shift could actually help boost capital markets activity through 2025. And they double down on the U.S. being this crucial global growth engine, dynamic businesses, deep liquid markets.
Okay, so a boost in sentiment to start the year. But they still see a lot of complexity and uncertainty ahead. It's not all clear sailing.
Not at all. Absolutely. While sentiment might have improved based on expectations, the actual direction of specific U.S. policies, tax reform, regulations, it's still unclear.
Right.
They acknowledge some potential policies could help growth, others maybe not so much, and they specifically flag the talk around potential tariffs.
Tariffs again.
Yeah, saying that could really weigh on corporate sentiment and hit companies' bottom lines.
So there's this tension then.
Yeah.
Between that initial optimism and a kind of lingering caution.
Exactly that. Policy uncertainty is always there, right? Especially early in a new political cycle. But they stress that businesses need clarity to feel confident making those big long-term investment decisions. And they're seeing it, they say some corporate clients are acting more cautiously, waiting for more certainty on where policy is actually going to land.
So despite this murky external picture, the firm itself expresses confidence in its own path.
They do. They wrap up that section saying they're confident in Goldman's trajectory, ready to serve clients, drive returns, and stick to their core values.
Which brings us neatly to those values. They've boiled down their sort of extensive business principles into 4 core values.
That's right. They listed them as client service, partnership, integrity, and excellence.
Pretty straightforward. Yeah. And there's one foundational principle that seems to guide everything.
Yeah, the classic. Our clients' interests always come first. And serving clients well is how they achieve their own success.
Makes sense.
They also really underscore that their key assets are their people, their capital, and crucially, their reputation. And they add that reputation is the hardest thing to get back if it's ever diminished.
A good reminder.
And they also reiterate the principle about finding and recruiting the very best people and the importance of diversity in doing that, and teamwork, putting the firm and client first.
It's clear the letter paints a really comprehensive picture. Past year, strategy, efficiency efforts, culture, and their take on a pretty complex world. We've certainly covered a lot of ground.
Yeah, it definitely offers a detailed look at their priorities and how they view the challenges, but also the opportunities facing them and their clients right now.
So as we wrap up this deep dive, maybe here's a final thought for you, the listener, to consider, drawing on what we've discussed. The letter points out this improved CEO sentiment post-election, driven by expected regulatory changes. But at the same time, clients are still cautious because of actual policy uncertainty. What does that gap, that disconnect, tell us about the power of political expectation versus concrete policy clarity when it comes to driving economic activity?
That's a great question.
And maybe, how should individuals or businesses even try to navigate planning in that kind of dynamic, sometimes contradictory environment?
Yeah, that interplay between perception, expectation, and reality. It has real consequences for investment, for growth. Definitely something to chew on.
Absolutely. Well, that brings us to the end of this deep dive into the Goldman Sachs 2024 Shareholder Letter. We hope this walkthrough has given you some valuable distilled insights straight from the source.
Thanks for joining us for this analysis.